Hello and welcome to session 15 of our Series 7 exam overviews, brought to you by Passing Score, where you can get more help on your exam prep at www.passingscorefinance.com. In this video, we'll be going over annuities. There are several different types of annuities and a few different features which we'll be going over today. But first, let's answer the question, what is an annuity? An annuity is basically an exchange of an upfront payment for a stream of future payments that will be paid out. The issuer invests that upfront payment in order to have a return that will finance that income stream. This is usually done for retirement purposes, and they can be tax deferred or after tax plans, and they can have fixed or variable payments and returns depending on the investor's needs. First, let's look at fixed annuities. These are considered insurance products and regulated under state insurance laws. The dollar amount is fixed over the lifetime of the annuity, which is the lifetime of the investor. And because of that, they're not protected against inflation. If inflation increases substantially, that will decrease the purchasing power of those future payments. The issuer invests that money in a general fund and guarantees the payments regardless of what happens to those investments. A variable annuity is treated differently from fixed in that they're treated and regulated as securities. The investor can choose different investment objectives from very risky to stable, low risk type of options. And the dollar payments will vary based on those returns for the investor's lifetime. There's no guarantees on the returns, of course, since the investor and or the annuity buyer is assuming the risks of that investment. If there's some delay between when the investor makes their upfront payments, and let's say they're choosing to have a 10-year delay until they start getting those payments back, that's called the accumulation period. The contract owner will reinvest the funds during that time, and those returns will grow the amounts of the pool so that the investor can have a larger payment in the future. Those gains are tax deferred, so the investor doesn't have to keep paying taxes or file on those every year. And during the accumulation period is the only time the investor can partially or fully withdraw funds from the annuity if they need to. If there's some withdrawal prior to their turning 50 and a half years old, there is a tax penalty, however. During the annuity period, this is the time when the payment stream starts to pay back to the investor. The accumulation units become annuity units. That just means that there's some accounting. This is the way that the accounting is done by the issuer, is keeping track of these units as estimates of for life expectancy of what they expect to be paying. Now, when these payments begin, the issuer can't surrender or withdraw their principal back anymore. They'll have to accept the payments. The contract owner, the investor, is known as the annuitant, and the annuitant receives one annuity unit per expected payment over their lifetime. Now, regardless of this accounting measure, they're still going to receive payments over their life expectancy regardless. Again, this is just a way for the issuer to keep track of their payments. There's several different ways in which the investor can receive those payments, several different types of payouts that can be done with different types of annuities. First of all, there's the straight life annuity. This is monthly payments over the lifetime of the investor. But if the investor passes away shortly after payments begin, they don't they or their beneficiaries will not receive any more payments. So they're taking their longevity risk when they're investing in this type of annuity. Now, if they live very long, that's the upside is that they'll keep receiving payments for however long they live. But there is a downside risk if they do pass away shortly and their beneficiaries receive nothing. To offset some of that risk, there's something called a life annuity with period certain, in which there's at least some minimum payments that will be made regardless of how long the investor lives, so that the beneficiary can receive payments for some minimum time from when the payments begin. And that can be a 10 or 20 years, it just depends on the annuity contract. If the investor lives beyond that minimum time, let's say it's 20 years, and they live to receive at least 20 years of payments, then they've exceeded the minimum, and once they pass away, there will be no payments to the beneficiary, since the issuer has made their at least their minimum obligation under the annuity contract. Other types of payouts include the unit refund annuity. Now, in this case, the investor's principal that they've put into it and the returns on that principal are taken into account in calculating if their beneficiary will receive payments. If the investor lives a very long time and has more than received their principal and returns on that, then the beneficiary won't receive any additional payments. But if they pass away before that principal and interest has been consumed, then their beneficiary will continue to receive payments until that amount is used up. Another type of payout is called a joint and last survivor life annuity. This is two separate payouts for an annuity, usually, let's say, spouses. But if one passes away, it doesn't affect or put at risk the payments made to the other recipient, so that the a spouse isn't at risk if one of the two passes away. So the payments will continue until both of the lifetimes of the annuity payment recipients. Now, when we're talking about an investment pool and long-term payouts, there's going to be something called an assumed interest rate that's being made to calculate some estimate of what the investment should return. An assumed interest rate annuity is where the investor, the person receiving the annuity payments, gets to participate in some of the risk, some of the upside, and also some of the downside of the investment returns. In our example here, we have an assumed interest rate of 5%. Now, if the actual return is 5%, they'll receive the expected projected annuity payment exactly as planned. But if the returns on the investment are higher, in this case 6.4%, they'll receive a little bit of a bump in their annuity payment. They won't receive a direct correlation of the investment. They're just participating in the risk without having 100% of the risk. So if the actual return ends up being 3.5%, they'll receive a slightly lower annuity payment for that period and or a slightly higher payment in our 6.4% scenario. So they're really participating partially in the ups and downs of the investment returns. Now we get to everyone's favorite topic, taxes. Annuities, because they work for retirement purposes usually, we can think of the tax implications being similar to that for an IRA, in which the initial investments are tax deferred and then the payouts uh, are taxed, versus something like a Roth IRA, in which we're investing after tax dollars, but we're not paying taxes when we're withdrawing the funds in retirement. We can think of annuities as having similar features. After tax contributions can be withdrawn tax free. Gains, dividends, capital gains are reinvested and are tax deferred. You don't have to worry about filing taxes on the investments every year. But there's variations based on the initial tax treatment of the investment when the payments start coming back to the investor. For non-qualified annuities, these are after-tax annuities. If there's an accumulation period, when the withdrawals start to come back, those are treated as receiving the gains first. So you're going to have to pay taxes on those gains. And then later, after those gains are used up and you're going into the principal, then you're not going to have to pay taxes on those any further. So you're paying your taxes up front with the first payments. Conversely, you can have for annuities without an accumulation period, those are tax-free, and the return of capital is considered as being received first, and then any gains later are treated as ordinary income. Now, if you have a qualified annuity, which means you had a tax-deferred investment, your payments will be taxed beginning with your first payment and on through the entire annuity time. Similar to like a 401k, where you're not paying taxes up front with the investment, but you're paying it on everything that you receive out of it later on. Those are for qualified annuities. Now, we also have, as with any type of investment, expenses. There's, in some cases, an expense guarantee, which limits the annuity expenses to a specified level. For variable annuities, remember, these are treated like securities, so they have to have a prospectus. And that prospectus has to detail what all their expenses could possibly be. And there's no limit on those expenses, but they have to at least be reasonable. Expenses can include management fees, administrative expenses, and other types of charges. Since all of these investors are getting together into an investment pool that will handle all of these annuities, they get some rights as to voting on how things will be run. They get to elect a board of managers. They can approve they do approve the independent accountant, and they approve certainly any changes to the objectives or policies which will directly affect them for sure of how the investments and the annuity will be run. And that's it for our annuity section. If you have any questions, please feel free to email me at john@passingscorefinance.com. And good luck on your exam.